I also would like to wish happy anniversary to GPF. Wish GPF a long and healthy life with good performance. I don't know if you know Larry Fortensky. Larry Fortensky is not an economist, is not a strategist or a journalist. Larry Fortensky is Elizabeth Taylor, the American actress, seventh husband. On the wedding night, he said to Elizabeth Taylor, "You know everything about it. You've been through it 6 times, but this time I'm going to try to make it interesting." So why I'm saying that is that I'll try to give you an overview of the macroeconomic situation in Europe. I'm sure you're aware of that. But this time, I'm going to try to make it interesting. So we'll review a few words on the pension fund of the State of Geneva. We'll see the post-crisis assessment and the macroeconomic situation. We'll see the implication for investors and how we deal with those challenges. And then we'll dig in deeper into the pension fund of the State of Geneva's investment strategy. So the pension fund of the State of Geneva is one of the oldest in Switzerland. It was founded in 1929, but then it merged lately in 2014 and was named CPEG. The pension fund has 12 billion under management and has about over 67,000 beneficiaries. Sorry, I'm going to change the microphone side. Okay. It's a defined benefit plan, and the team is composed of 100 people, and the long-term target return is 4.1%. And CPEG received the IPE Country Award and was amongst one of the best performing pension funds in Switzerland last year. So post-crisis assessment. Since the last financial crisis, financial markets were mostly driven by central bank policy rather than fundamental forces. We live in a crazy world that is upside down. I'm borrowing money from you and you pay me for that. So the message is continue to borrow and create more debt. So this is what we're experiencing at the moment. So this super debt cycle is something that worries me. I have a special slide on that. And since the last financial crisis, government corporates have increased dramatically their debt to incredible levels. And since several years, central banks have taken this debt on their balance sheet. Now, the central bank's behavior, by injecting a lot of liquidity in the system, are altering investors' behavior and compressing asset class return to extreme low levels. And this trend is going to continue. The good news is central banks have expanded their mandate, and they're now looking after financial market stability. So when markets correct by 15%, they intervene to stabilize the market. So that's a good news, because it's like a put that they're offering to investors. I don't know how long this is going to be available, but that's the situation currently. But the situation is there to last, because stimulus programs take years before it shows positive results, and it takes years before we can get rid of them. So now this is the super debt cycle. A few words on the super debt cycle. It has reached now 325% of world GDP and rose to a record 217 trillion. Now, if I add to this figure the unfunded liabilities, which represents 500 trillion, and if I add to that figure the derivatives market, we are above a quadrillion of debt. So no government, no one will be able to pay back in real money this level of debt. Now the issue is to service the debt. So corporations and households have been also accumulating a lot of debt. And just in the US consumers are now more than 12 trillion in debt. America's debt to GDP ratio, adding all forms of debt together, is now over 350%. So now the question is, can the situation continue forever? Well, the only way to continue is to grow debt at a faster pace than the economy is growing. So for this reason, I believe interest rate will stay low for a while. Some countries cannot afford higher interest rate, like Portugal. So my message here today is that the big picture hasn't changed. We are in a deflationary environment. The super debt cycle is going to continue. However, on a short-term point of view, we're seeing a lot of rapid changes. Now, we're seeing in Europe a breakdown of a country, UK, Brexit. We're seeing also in the US, deregulation after re-regulation. We're seeing deglobalization after globalization. But I believe that these are short-term changes that are not going to last. And globalization is a no-return trend. And the big picture hasn't changed. So what are the reasons to be optimistic? We've been through a major financial crisis in the US, and that has been solved. We've been through a European sovereign debt crisis, and this looks to be under control. We dealt with the US deficit, with the debt ceiling. Now this is being questioned with Trump agenda. The soft landing of the Chinese economy in terms of real estate, currency depreciation, shadow banking, corporate leverage. But people must bear in mind that China is under control and is not a big worry, in my opinion. Because China is the second largest economy in the world. It cannot grow indefinitely. It has to be, mathematically, if you grow at a certain percentage, you double your size. So China cannot double the size of its economy. So a soft landing, a slowdown, is something that has to, it has to happen. Now it has to be in a controlled fashion, and that's exactly what the government is dealing with. Unemployment in the US is now at historical low levels, and it's still an issue in Europe, although it's coming down now gradually. A restructuring of the banking sector in the US, it's still under construction in Europe. Stabilization of oil prices, we went to $140 a barrel, and now we are under $50, but it's stabilizing. And then we start to see synchronized global rebound in the US, in Europe, as well as in Japan. But we should be very cautious about Europe as well as Japan, because we're coming from very low levels, and expectations are very, very low. So a small increase has a big impact. So it's all about the base effect. Now the reasons to be worried. Well, first, the normalization of the monetary policy. And this year, the European Central Bank will have to give a clarification of what is going to be the policy for next year. Are they going to continue to stimulate the market, or are they going to normalize? And the message will be very important. Communication is key, and I think it's a big challenge for ECB to announce what is going to be the plan for next year. We have high valuations across the board and persistently low interest rates. Something that really worries me is the financial market liquidity and leverage. There is simply no liquidity in credit markets as well as equity markets. And we should take that into account, because this could create a lot of volatility going forward. We have political risks, especially in Europe. We have the consequences of the Trump agenda, US deficit, strengthening of the dollar, anti-globalization, and trade tensions. Now, I believe that this is a lot of noise, because a lot of people are bullish about infrastructure in the US, but look at Canada. They've been implementing infrastructure projects for the last 5 years. We don't see much improvement in growth. So even if Trump manages to implement those infrastructure projects, it's going to take years before it's visible. It has a visible impact. Now, the biggest risk we have is the central bank effectiveness, because the day people question central bank effectiveness, we'll have a big issue. But the last financial crisis happened in a very stable political environment. But that's not the case today, especially in Europe. So to me, this is one of the biggest risks with central bank effectiveness going forward. So we're experiencing now several paradigm shifts. The first one is inflationary against deflationary environment. Or I should have stated reflationary against deflationary. Now, I believe we're in a major deflationary trend. And technology is a big component in that. You know, those devices, every year, the cost is coming down. And this is not going to stop. I think robotics is also going to bring prices down. And also, we have a big trend amongst corporates because they have access to cheap funding, cheap credit. So instead of being bankrupt, they can have access to cheap credit, and they lower their price to stay competitive. And all this is bringing prices down. So I think this trend is going to last. We have monetary policy divergence between a normalization in the US. We start to see some tightening in China, but elsewhere we have still accommodative central banks. We have domestic agendas taking precedence over global ones. So we'll see UK, we see US, maybe we'll see other countries. And this will lead also to differentiation in terms of outcomes in different countries. So it's not a region that could be impacted, but just a country. Fiscal stimulus is favored over monetary policies, although I believe that this trend is going to continue, and we'll see both monetary policy as well as fiscal stimulus. There's deregulation over re-regulation. There's global trade that is no longer a big component of global growth. And this is new because usually global trade was related to global growth. But today, global trade is below global growth. But since this year, good news is good news. You remember since the last financial crisis, when macroeconomic data was sluggish, stock market were going up because market participants were speculating on an intervention of the central bank. But now this trend is changing, and since this year, good news is good news. Well, good macroeconomic data leads to higher equity markets. So what are the lessons learned from the last financial crisis? The first one is not enough macro analysis. So I don't think the role in a pension fund is to define where the euro dollar is going, but to define opportunities as well as risks. And my role as a CIO is to expose the pension fund to those opportunities and, if possible, to reduce the risk that is visible. Another lesson learned is the importance of portfolio construction, the importance of asset allocation and position sizing. I put a lot of importance into position sizing. To produce a return, you need three things. The first one is a good investment idea. The second one is the right size. And the third is the good timing. You can be wrong on the good idea and the the investment idea, but if your position is appropriate, you don't suffer too much losses. So position sizing is key. I believe in disciplined investment process. You have to stick with your guidelines, you have to stick with your investment process, and you should, this is another advice, is to stay away from the noise. And you should take advantage of quiet markets, this is the case today, to define risk reduction or hedging strategies. Because when markets become more volatile, that's the worst moment to take decisions. So those hedging decisions have to be taken during quiet market environments. I think also it's important to invest with high conviction. And how do I define conviction? Conviction is a fundamental analysis, it's a technical analysis, and a catalyst. If the three are aligned, then you have a high conviction. When I joined the CERN pension fund, they had 600 million exposure to the euro. So I said we should hedge this risk. And they said, no, historically we've been doing well with currency exposure. And I said, look, from a fundamental point of view, the Eurozone is going through a hard time. From a technical point of view, you could see that things were going down, and the catalyst was Greece. So thank God that position was hedged, and it saved a lot of risk in the portfolio. So we'll see later on the importance of risk management. The risk management should allow us to assess the appropriate diversification of the portfolio, to perform some stress tests and sensitivity analysis, liquidity analysis as well, and then the operational setup and see if your counterparties are at risk or not. So what is the implication for investors? So in this environment, investors are forced to take more risk. More risk in terms of quality, so we have to go down the quality, use more leverage, or go less liquid. Investments are made on a relative basis. So instead of investing in equities because we like equities, we invest in equities because we don't like bonds. And this is wrong. The time horizon is becoming shorter and shorter. The only thing we have, pension fund, is the long-term time horizon. It's the only asset we can count on, but we are being checked on a monthly basis, on a weekly basis. And I think this is something we have to manage, is to keep the time horizon in the long term. We're seeing a fee compression across the board, and that's a good signal. I think the institutional industry is putting a lot of pressure on the managers to bring down the fees. I think this is positive. The role of fixed income strategy is being questioned because it doesn't protect anymore. It's vulnerable to interest rate hikes. And the yields are very low. We're seeing investors selling active managers to invest in passive solutions, and everyone is doing the same thing at the same time. But I believe that there are good active managers, and it's the wrong moment to give up on active strategies. ETFs, so exchange-traded funds, are gaining ground. In the US, 1/3 of the volume are coming from US ETFs. So these are the examples of the quarter trades that we have in Europe. The first one is real estate. Domestic, international, everybody is crazy about real estate. We have infrastructure, and since President Trump was elected, this is becoming more and more popular. We see a lot of insurance-linked securities, strategies, private lending, and structured credit. These are the crowded trades that get calls almost every day. And lastly, hedge fund strategies are challenged for poor performance and high fees. So I try to illustrate, I know it's I'm the slot right after, sorry, wait, just wait a minute. I'm the slot right after lunch, so I try to make it interesting. This is to illustrate investors' behavior. We are all doing the same thing at the same time, and this is what worries me. So please, thank you. Okay, so we're looking for yields everywhere. We're trying to see the best yields. And then at some point, we find an investment idea. We'll see some interesting investments, and boom, we all move in the same direction, the same way. So we invest heavily. We grow our allocations. At some point, it looks risky. We don't know what's the catalyst, and we move away. So we sell it. We want to be out of the position. And again, we're all moving at the same time in the same direction. Okay? Now, I'm very worried about the fixed income market because it's so totally illiquid. I pray that it's going to happen this way, because I think we'll see a lot of operational issues in the fixed income market. So what are the investment risks? So today, it's extremely difficult to diversify portfolios, and I'll give you an example why. Liquidity is poor across all asset classes. Rising interest rate may impact your bond portfolio. We see monetary stimulus unwind, especially in Europe. and quantitative big data, high-frequency trading. I see a lot of strategy that are attracting a lot of investors that are doing exactly the same thing with the same parameters. Just in risk parity, I don't know if you came across this strategy, in risk parity we have 6 billion of assets in the same strategy. So when there are market corrections, all those models react the same way. And because of big data, because of those quantitative strategy, this emphasizes market movements. So I expect, therefore, to see more volatility. Historically, we saw 4 catalysts that can interrupt a bull market. The first one is a war. The second one is a breakup of a country. The third one is a spiral of rate hikes in the US. And then a severe economic recession. So 3 possible scenarios from here. So here we have the first bubble, internet bubble. Is it working? Internet bubble, credit expansion. Market correction, we have the subprime crisis. Banks take all this on their balance sheet. We have the subprime crisis. And then credit expansion, central banks take all this on their on its balance sheet. Now from here, we are at the top with the red dot. Oh, thank you. The red dot. So scenario 1 is paradise. Paradise, a sustainable global growth. So equities continue to go up, and that's bad for bonds. But the speed is going to be key. If growth is too high, it goes up too rapidly, then central banks will need to hike, and this will be a big danger. But if it's steady eddy, then we find it's paradise. And by the way, this is the big bet of central banks. Second scenario is hell. The economy goes sideways, and this low yield and low return environment continues for years. And we have to deal with that. And then scenario 3 is purgatory. It's a global economic slowdown, financial crisis, and you see that the downside is quite significant. Now, Now let's see what is good in each scenarios. For paradise, good for equities, only if it's a steady eddy growth. But if growth is too strong, then we'll see interest rate hikes, bad for equities, bad for fixed income. Hell, economy going sideways, situation that we're experiencing today, bad for equities, good for fixed income. Now purgatory, a huge market correction, financial crisis, bad for equities, good for bonds. So out of the 3 scenarios, 2 are positive for fixed income strategies. So let's talk about the pension fund of the State of Geneva investment strategy. So this is just a chart to show you a classic 60-40 portfolio managed in the US. So 60% equities, 40% bonds. And you can see that the returns have been great since the last financial crisis, but they're coming down. And I think we still are expecting lower returns going forward. So we manage 12 billion. We have a global investment strategy. The base currency is Swiss franc. The investment strategy is benchmark oriented. The long-term return is 4.1%. Since 2015, we've adapted the strategy to allow tactical investments. And this is to take advantage of central bank puts. So when equity markets correct by 15%, we buy. And then we take profits when markets appreciate. We have socially responsible filters across all asset classes, if possible. For example, we don't invest in commodities. And then the asset allocation can be summarized in 3 pillars. 30% of bonds, 30% of equities, and 30% of real estate. The remaining 10% will be allocated into private equity, into insurance-linked securities, as well as cash. So the basis of the investment strategy of the pension fund of Geneva is very simple. We collect asset class premiums. So we collect rents, we collect dividends, and we collect coupons. Why do we focus on those premiums? It's just because they're predictable and they're sustainable. So I'll give you an example of what we collect every year. So the investment strategy is based on the asset allocation as well as tactical deviations. And our role, the investment team, has to enhance the yield of the portfolio and to implement capital preservation actions, such as when markets correct, then we reallocate, we reconstruct our positions, but we also rapidly take profits on our risky assets. So these decisions are taken based on macroeconomic analysis as well as risk analysis, and you'll see an example later on. We have a huge investment constraint since January 2015. You know that the Swiss franc is a reserve currency. And in order to stop the appreciation of the Swiss franc, the central bank has imposed a minus 0.75% on cash. So this is a huge constraint that we have because it's impacting our hedging strategies, and it's also impact the cash that we have with our counterparties. So the rents, we're going to collect 150 million per year. Dividends, we're going to collect 110 million per year. And then coupons will represent 50 million. So altogether, we get a 2.7% yield from those asset classes. And this is no matter if markets are going up or down, we're going to collect those premiums. Now, if I add, and we stressed this figure. We said, look, if we are in a worst-case scenario like a 2008, what would be that yield? And this yield would be coming down to 2.2%. So it's not too bad. Now, based on academic studies in long-term capital appreciation, I don't want to give you a headache, but we've estimated that the equity portfolio in the long run should add a 1.2% per annum. So altogether, we should have a 3.9% per annum over the next 10 years. Now, if you cumulate all those yields, it starts to be very interesting at the portfolio level. Now, let's talk about portfolio construction and investment decision. This is a recent approach. It's called factor-based risk analysis. It's a decision aid tool. You probably came across this approach. It gives us an idea of the diversification of the portfolio, and also you can visualize the sensitivity of the portfolio to macro factors. And this is about determining the right balance in the portfolio. And again, I'm emphasizing the fact that position sizing is key in a portfolio. So in 2012, some institutional organizations were surveyed about what would be the allocation based on for the next 10 years. And 35% of them answered that the allocation would be based on risk factors. So it's just to show you how interesting this approach is. And that was in 2012. Sorry. Okay. So the objective is to define the main risk drivers across the overall portfolio and to give some market context in the decision process, include other dimensions into the portfolio analysis such as liquidity, operational leverage, and systemic risk, and perform some simulation. So this approach is a very efficient way to construct portfolio, and it explains why some asset classes move together. So we'll see some obvious some less obvious relationships between asset classes, the portfolio sensitivity to macro factors, and then the degree of diversification of the portfolio. So here you have a simulation of a 1% loss at the portfolio level, and you'll see what explains those 1%. So you can see that the biggest risk today is coming from the credit portfolio. So US high yield, domestic bonds, US treasuries, investment grade corps. And equity risk is at the far end of the simulation. So the less risk is the topics, Euro stocks, MSCI emerging markets, Swiss equities, and so on. So this was a big surprise for the board because they thought the biggest risk were equities, but actually it's the credit market. This, and the reason why it's interesting for board members is that it's very easy to understand. The closest you are to the portfolio, the biggest sensitivity you're going to have. So let's say this is in green, you have the portfolio, the overall portfolio, and you can see that it's close to domestic bonds. It means that domestic bonds, the portfolio has a lot of sensitivity to domestic bonds and to US high yield, etc. Then you see another group, and you see a third group of macro factors. So this shows you today the lack of diversification. You can invest in 3 different groups only, because all those markets are highly correlated. What's interesting is that you see here US equities, the S&P 500, and you have here US treasuries. And they're becoming closer and closer. This should be here, but it's moving into direction. And you probably see a lot of investors selling their US treasuries and buying S&P 500. And people are calling now the S&P 500 as the new treasuries in the US. So this, you can visualize this relationship between US treasuries and S&P. It's becoming closer and closer. Now, the board said, how can I diversify the portfolio? Well, and that was at the end of last year, in October. We do this twice a year. So Euro stocks and topics are far away from the portfolio, which means that they're good diversifiers. So these were identified. And by the way, they performed extremely well at the end of last year. And when we see this, the question was also, can we enhance the yield of the portfolio? Can we go down the quality curve and can we invest in direct lending, for example? But then the conclusion of this analysis was 54%. Sorry, I come back to that. This is a 3-dimensional visualization of the portfolio. So we have 20 dimensions, and they were simplified in 3. And this is an output. Can you please click? Okay, you have in yellow the portfolio here. And these are the relationships between all the market factors. So you see here in blue the topics and the Euro stocks, and you see how they're related. And this gives us even more information than just 2 dimensions. It was just to illustrate this. Thank you. Okay, so now it's all about, this is the asset allocation of the pension fund. So we have 25.2 invested in international bonds. But your risk is not limited to those 24%. Actually, your risk is higher because in certain market conditions, some markets become correlated. So this is the risk allocation. So you remember the big graph? This is the aggregation of the risk. So the board thinks, okay, our risk with bonds is only 24%, but actually it's 54%. So now do we want to increase this allocation? The answer is no. So we didn't invest in direct lending. So this really helps us to give some clarity in the decisions that we're taking. So we see that the international equities 20% allocation, but the risk is only 16%. So these really help you to see where you can diversify, where you can increase the yield of the portfolio. So as a conclusion, I think we should stay away from the media noise, the Trump agenda, all this, elections in Europe. I consider this as noise. I think it's interesting to assess the sensitivity of the portfolio in order to assess the extremes and also assess the concentration in your portfolio that you may not see at the first stage. I think you should take opportunity of quiet markets to already think about a contingency plan. If markets become more volatile, this is what you're going to do. And you can prepare the board members of the actions that you're going to take in case volatility is going to increase. But when volatility is there, when market correct, that's the worst environment to take decisions. I think you shouldn't change your investment strategy, but you should adapt it. Up to last year, the whole yield curve of the Swiss government bond was in negative territory. The government issued a bond, a 50-year bond, and it gave the negative yield, just to give you an example. So we got rid of all the Swiss government bonds. So this is what I call, we didn't give up on fixed income, but we gave up on Swiss government bonds. I think you should neglect your currency hedging policy. That's your second biggest allocation in your portfolio. And I think you should really make sure that you go along the risk that you're taking. You should take advantage of the rallies and the sell-off to rebalance your portfolio. And this is, again, thanks to the central bank put. So when markets correct, you should reallocate. Last year, January, February, you remember markets were down a lot, like 15%. We bought 500 million of assets, and we sold them 3 weeks later because it was up 10%. So these movements are opportunities for you to take advantage of those volatile markets. And also, I highly recommend you to stick with high-quality assets, assets that you are comfortable to hold in case there is a financial crisis. Now, I think markets have been exceptionally quiet, but I think this is going to change. And I think the board should be prepared for extremely higher volatility due to exceptional uncertainty and low predictability. I think you should really focus on diversification and liquidity and stay away from crowded trades. Also, we're looking at the payout ratio of investments. If the payout ratio is like 2% upside and 15% downside, then we tend to reduce the exposure. And then the last recommendation, and this is a trend that is growing, is to team up with other investors to construct strategies to fit investors' needs and also bring down the fees. So, for example, in Switzerland, a few investors have teamed up together to work on a strategy. We have identified a manager. We secured some capacity. We reduced the fees almost by 50%. We added some socially responsible filters and so on. So this was a strategy tailor-made for us. And I invite all the pension fund and institutional investors to team up to create those strategies that are designed for us. Thank you for your attention.